Okay, I promised you a little tutorial on doing the discounted cash flow valuation model because there's a fair amount to this. Um, so let me get started. I'm obviously on the home page of our course in Canvas, and if you go to Module 4, your screens may look different. Obviously, I've got a faculty version here, but Module 4, and go to the resources page. And most of what you're going to need is right here. So the first thing that I suggest you do is watch this Dama-Duran's basic valuation exercise. It's a video.
You know what I find fascinating about valuation? It's really not a science. Science in the sense, if you put input, you get the right output. It's not an art. You can't make up numbers as you go along. It's a craft. And what I find most interesting about valuation is the intersection between stories and numbers. That's the way I think about valuation. A good valuation, every number should be singing a tune.
So that's Professor Dama-Duran. And this video, first of all, those are great comments about what valuation is. This video walks you through, it's almost half an hour, I think. It walks you through how he does a valuation of Apple. It's a little dated, April of 2013, so it's kind of fun to see what he comes up with and what his conclusions are. I'll leave that up to you to not give out a spoiler. But watch this video. Don't worry about the details. Don't take a lot of notes. Don't try to replicate what he's doing. Or while you're trying to do yours, just watch what he does, and it gives you an idea of the information that you might need, what you kind of need to have prepared before you get started. Now, for what it's worth, the spreadsheet that he's working with here, I have included in these resources. It's this FCFF Simple Ginzu, free cash flow to the firm, and Ginzu models are his kind of all-in-one sort of things. So this model here, so the simple Ginzu model, which is the one that he uses in the video, I've downloaded this, I think just now, but I've had it saved as well. And this is what, if you download the one from Canvas, this is what should come up. So this is a valuation he did of Shake Shack back in January of 2018. Again, if you want to work through this, look through, generally on these, always the yellow items are where you input information. Green is an output. You don't generally want to change any of those things. And as you start looking to see, there's all kinds of good data in here that he uses based upon the inputs that you put in. You can also, off of Canvas, download an empty version of that simple Ginzu model. I've gone through his download and just cleared out all of the company-specific information. So if you want to, you could start from this model and input what you need. Again, kind of follow his video. He'll walk you through where, what you need to do. And tell you how to interpret some of these results. Obviously, right now everything is empty, but this is a good option for you if you want. And notice that he does give you, descriptions here where he tells you what to put in. So make sure you look at the comments that he has included in this. This is a good option for you. It's very complex, very flexible. Might require a little bit more work and input than is technically necessary for the assignment, but it's a good choice if you want to go above and beyond. So if you haven't explored it, if you go to the Dama-Duran online website, And I'm sorry that you don't see the whole thing here. I think I have it in other weeks' listings. And then you go to his tools page, and he gives you a whole bunch of links here to spreadsheets, webcasts, videos, all types of things. Where I like to go is go to the spreadsheet one. I'll go back up. And at the top here, if you look and it says valuation inputs, takes you lower onto the same page here and gives you access to all of his Excel spreadsheets that he uses for valuation. Some of the most important ones I've put on or the most useful ones I've put on the Canvas website. But if you want to play around with this, you see lots of things here. Things like estimating a beta for your stock, calculating accounting returns. There's one here for calculating a WACC. I decidedly did not tell you that before I had you do the last exercise. But you can use any of these spreadsheets to help you find information. For the valuation, there's some basic ones here. There's one we'll look at in the middle, this model XLS, that will help you decide which one to choose. And as I said, then he has some of these Ginzu models, which are very flexible but a little more complex. Most likely, you're going to come down here and use one of these focused valuation models: free cash flow to the firm, free cash flow to equity, and either a stable growth, a two-stage growth, or a three-stage growth. So the first place to start then is obviously to choose a company. Get familiar with them. Get a hold of their financials. At a minimum, their last 10K. If their last 10K is 2 or 3 months old, maybe look at their last 10Q to try to get some more updated information. In one of the discussion posts, someone commented, I can't recall now who it was, about reading an MD&A. And I replied, that's great news or a great recommendation, but tell us what an MD&A is. Management Discussion and Analysis. MD&A is part of every 10K. It comes just before the financial statements. And it is management's discussion of what has happened in the business, and in many cases kind of what some of their outlooks are. And the outlook part 2 then was, why I have you do an earnings call. So if you choose a different company, you might want to listen to a recent earnings call just to kind of get familiar with the company as well. So once you've chosen the company, got a little background on it, then go to this model chooser spreadsheet. So this is the actual Excel model from Damodaran to choose the right valuation model. And I'll just walk through it with you to show you what you need to do in this first step. We start here right at the top, and we're going to look at your company. And the first question is, do you have positive earnings? And I should have probably said this earlier, but if you pick a company that, or you should pick a company that is quite stable, maybe mature, it just makes things easier. If your company is losing money, you can still use these models, but it's a lot more complicated. Don't choose Tesla. Everyone's going to want to choose Tesla. Don't choose Tesla unless you like the idea of pounding your head against the wall. So pick a company with positive earnings and a relatively stable business model, and probably best, mostly U.S. based company. Right? Then we move to some kind of economic inputs. What is the expected inflation rate in the economy, and what's the real growth rate of the economy? His default here is a 3% inflation rate. That's, to me, maybe a little bit high right now. Most people say 2% as an inflation rate. The idea, again, is the dividend discount model, remember, is a perpetual model. So that's what is inflation going to be over the next 100 years, right? Same with expected real growth rate in the economy. He's using an estimate here of 2%. This is, go back to your economics class, this should basically be growth in productivity and population growth. I like to use more like 1.5% today. Then we go back to your actual company and we'll talk a little bit about its growth rate. We're going to make an estimate here is what do we think its growth rate is going to be in the near term over the next 5 to 15 years. Remember, because of that perpetual nature of the dividend discount model, a company can't grow faster than the economy, right, forever, or it basically becomes the economy. So we would choose a rate that you think represents what it can grow in the next decade, let's say, presumably something a little bit higher than the economy in the long run. I'm going to use Lowe's, the home improvement store, so I'm going to use a number here like 8% to start. Then the question is, does this firm have a significant and sustainable advantage, a moat? Can it generate higher return on investments than its cost of capital over the long run, or at least over the next 10 to 15 years? And that it determines how quickly that excess growth rate goes down. For Lowe's, I'm going to start out saying no here. If your earnings are negative, again, if you've chosen a company that has negative earnings right now, you can continue down this path, but it's going to complicate your work a fair amount. What's the current debt ratio of the firm? This goes back to that weighted average cost of capital, the WACC exercise. And you need to determine what is the market value debt ratio. So we're going to look at the market value of debt. It's fine to use the book value as an estimate. And we're going to compare it then to the total market value of the firm, the market value of the debt and the market value of equity, what's called the so-called market capitalization. You have to do that at market value in total. And again, the debt ratio, as you can see, it's debt basically to total assets. It's not the debt to equity ratio. Don't pick that up. You want debt to the total capitalization, which should be basically total assets. I haven't looked at Lowe's on a market value basis for a while, but I'm going to say it's 30%. Then there's a question about, is the debt ratio going to change? Do you think the business is in the process of changing their strategy, changing their capital structure? All right, let's start with no for Lowe's. It's going to be pretty stable over time. Then we get into what is the company's dividend policy right now? How much of their earnings are they paying out? And this information you can all get off of the cash flow statement for your firm. I posted in a picture here of Lowe's cash flow statement from a recent news release. You might run into a case where you don't have the current annual report for a company, but if you look at their year-end earnings release, you may have a cash flow statement in there along with their balance sheet and an income statement. So how much did the firm pay out in dividends? Lowe's paid out over the last couple years $1.45 billion in dividends. I can make some estimates here to capital and structures, capital expenditures. And so we will look at some other cash flow items. Net income starts off right at the top of the cash flow statement, $2.3 billion for Lowe's. What was their depreciation? Over the last years, roughly $1.6 billion. We'll just use this numbers. Again, this is just to estimate to help you determine what model is appropriate to use. What is their capital spending? Down here, right? Capital expenditures and maybe acquisitions of businesses. You might want to look over the last couple years and see what sort of the average is. I'm just going to go with last year's for now with Lowe's. And then a number that can be fairly hard to estimate change in working capital. This is things like inventory, payables, receivables, and that can be pretty volatile for most businesses. So look over the last couple years, come up with an estimate of what you believe they will need in working capital. The basic idea is if a company is going to grow, it needs additional working capital. It will require more inventory. It will require more accounts receivable. So you're going to have to come up with some number here. Again, because this is very volatile, it's hard to pick a good number for Lowe's. I'm just going to say $500 million. And what he's done there is you can then compare basically your dividend policy, your dividend payout, to the free cash flow to equity, the cash available to shareholders. But the real value is, okay, the output is which model should I choose? And because of my assumptions up here, he's saying I should use a model that is a free cash flow to equity model and a two-stage growth model. And then my growth will go from that estimated growth rate I put in to the economic growth rate over a 5-year period. Right? And that's the model that I'm going to end up using. So I'll go to the Damadron website and find the best model for that. You can see that if I change a couple things, first of all, changing that capital structure. Suppose I think they're going to change their capital structure, then it's going to tell me to, I thought that would, just using dividends. Oh, I changed the wrong one. I'm sorry. Here. Is the debt ratio expected to change? Yes. Okay, well then I probably need to value the firm and then adjust for that new, the capital structure. If I change my growth rate, let's say I think Lowe's can grow at 15% for the next few years, you can see now it's going to tell me to use a 3-stage model. Basically, that high growth rate exists for 5 years, and then over the next 5 to 10 years, that high growth rate gradually declines down to the economic growth rate. And it does it over 5 to 10 years, basically because I said they don't have a sustainable advantage. If I change that to yes, right, then it's going to allow that high growth rate to continue for a longer period of time, but still go through a 3-stage process of high growth and then gradually declining down to the economic rate. So once I have this, right, then I go to the Damadron website of spreadsheets, choose the correct valuation model that he is indicating here. So what I would say for you is once you get to this step, chosen your company, you understand a little bit of its strategy and its results, and you've done this model, then give me a call. Send me an email, send me a text saying, hey, here's what I've come up with. Here's the company I'm looking at. Here's what it's, the model it's telling me to use. What do you think? And I'll be happy to kind of help you out with that. And then you can get started in the more complex part of actually building in one of these Damadron models to help you value the firm. So once you've been through the model chooser spreadsheet and you've got an idea of which model to use, you still sort of have two choices, and I hinted at this earlier. You can certainly use this simple Ginzu spreadsheet that you watched the video on. It's a great exercise, requires a lot of information, a lot of understanding of the financial statements. And if you do that, terrific, you're going to get a great outcome. You might find it easier, though, again, to go to one of these focused valuation models. And that's what the model chooser is really pointing you toward. It's going to tell you whether or not you should be using a free cash flow to equity firm, model, or a free cash flow to the firm model. It's going to tell you whether or not you should be using a stable growth 2-stage or 3-stage, right? So those are all here, and you could then choose one of those and use that for your model. They're much more focused, take much less input, and give you a reasonable output. So that should be where you focus on that. Let me say that this is not an easy exercise. It requires a lot of knowledge and understanding. I am more than happy to, answer questions as you're working on it. If you want me to help you walk through certainly the model chooser part and get you familiar with the company, if you get stuck on a part in the valuation exercise using Duran's spreadsheets, stop and give me a call. We can Skype in if that's possible for you, or do a Blue Jeans, and I will, we'll share screens, and I'll be able to walk you through what I think you need to do there. This isn't about trying to make you bang your head against the wall. If you don't know what he's asking for or what information is needed, it's about you kind of learning what that is. So when you get to that point, feel free to get in touch with me. If I'm free, we can talk right then. If not, we'll set up a little bit of time and we'll get together and work through it individually with you. So good luck with this. Hopefully this tutorial has helped a little bit. And as I said, feel free to reach out to me if you have any questions.